All right, what's up, guys? Welcome to the Jay Martin Show. My name is Jay Martin, and my guest today is Julian Brigden, the co-founder of Macro Intelligence 2 Partners. And Julian has an amazing track record of exploiting trading opportunities within the macro environment. Today, I wanted to find out where he is allocating capital. As always, beneath this piece of content, there is a link where you can subscribe to my weekly newsletter. I absolutely love writing it and would love to have you join the team. I publish every Sunday and it's free. All right, here is Julian Brigden. Enjoy.
This is Jay Martin.
All right, here I am joined with Julian Brigden. Julian, it's great to have you on the show.
Thank you very much for having me, Jay.
Well, I'm excited to talk about a handful of things with you today. Let's start with this. There was an article in Reuters that was supported by Morgan Stanley last week that said, you know, the UK and Europe are probably headed for quite a deep recession. But Morgan Stanley in this article predicted that the US would largely jump over that, would be a bit immune to the worst of the economic downfall. Now, what do you think about that idea?
Nice one. I mean, very handy. I never usually view the world as quite that simple, certainly because it's very connected. And I would agree that Europe is looking at a really ugly recession. I mean, if my forward indicators are correct, we're potentially looking at a recession in continental Europe next year, which is the worst thing we've seen in 30 years. So in other words, worse than the global financial crisis, worse than we saw during COVID. Dynamics could change, don't get me wrong, and the models are in themselves dynamic, but I kind of use them to anchor my views. And until they change direction, which they haven't done, things look pretty dire. I think it's very convenient if you're a large US equity shop, which Morgan Stanley is to some degree, to talk a bullish line, particularly for your wealth management clients, who generally, these guys are only interested in accumulating assets and not really making you money, right? That's how they get paid. They don't get paid like a hedge fund does on a percentage of the money that they make you. They just get paid for your assets sitting in their account. And they like you to sit in stocks and they like you to remain bullish because they can't time the market because it's not their business. So when I look at the US, I would agree, as things stand at the moment, Jay, we are flirting with some recessionary kind of indications, particularly in housing, and some of the manufacturing side has been flirting kind of levels which you would associate with recessionary prediction, but we are certainly not there yet. And the rebound in the equity market, which we're currently seeing, and the rally that we're seeing in the bond market with lower bond yields are both commensurate with something that Jay Powell talks about a lot, financial conditions. And actually, this is an easing of financial conditions. So they're commensurate actually with growth remaining relatively solid. So from that perspective, you say, oh, Morgan Stanley's right? We are not in recessionary territory. The problem with that is that is something that the Fed cannot afford. May sound odd, but they really cannot afford. The Fed needs to drive us into recession to have any hope of getting to grips with the inflation problem. If you look at US nominal GDP, so in other words, real growth plus inflation, okay, it is 10% above trend. That's not a rate of change, that's in absolute terms. It is 10% above trend. That is utterly unsupportable. We are not an emerging market. That is over double anything that we have seen in the last decade. And as I said, while things are beginning to show signs of improvement, it simply is enough. So even if, let's say, inflation dropped away, let's say we get really lucky, Jay, right? Inflation goes from 8.5 at the high, let's say it goes back to 3.5, right? And nominal GDP stays where it is roughly now. The rate of change on nominal GDP is about 8. That would mean your real GDP will be 3. Well, trend real GDP in the United States, Jay Powell told us back in the spring, is 1.75. So even if inflation drops away, we cannot support nominal GDP of 8 and real growth of 3, right? Not with 3.7% unemployment. So even if inflation implodes, which is quite unlikely, statistically generally doesn't do that, the Fed has to keep raising rates. So the bottom line is Morgan Stanley might be right here, right now. We do not have signs of a recession. But the very fact that we don't means that something else has to give. Either financial conditions have to tighten under their own fruition, or the Fed needs to keep going and be much, much more robust than people realize. And I think we saw inklings of that on Monday, where Chris Waller, the governor, came out and was like, whoa, guys, calm down, right? One decent print in inflation does not solve the problem. And look at this labor market. And I think that's the thing that people don't get, Jay, right? This labor market has to soften. The Fed has in their forecast a material rise in unemployment to 4.4%, I think, next year. By the way, you've never had a 0.5 increase or more without a recession. And we're coming from 3.5, so 4.4 would definitely be a recessionary indicator. They can't say that, right? Because of the politics around the FOMC. And they don't want to be hauled up in Congress saying, what? You're actually trying to drive unemployment up and create a recession? But the answer is, yes, they are. So Morgan Stanley can be right for now. But if they are right, the Fed's just going to have to try harder.
Now, do you think, are all the big name tech layoffs that we're seeing over the last couple of weeks, forecasted to see over the next few weeks, are they enough to make a dent in that unemployment number? I mean, you said, the Fed wants to drive to 4.4%. We're at 3.5% right now. So,
yeah.
I mean, they're big numbers, right? But relative to the population, are they big enough? No.
And I think you've got to bear in mind, I mean, look, part of the problem that we face in the US is what we refer to at MI2 as hyper-financialization. So what I mean by that is that if you think of the world, if you think of the old chicken and the egg analogy, right? Which one's the chicken, which one the egg? Is the real economy the chicken, or is the real economy the egg, or is the financial economy the chicken, or is the financial economy the egg? So what you should say is the real economy, right, should dictate what happens to inflation, to growth, to employment, right? And that should drive asset prices or the financial markets, right? So that should determine where bond yields go, that should determine where stocks go, et cetera, et cetera. In the US, it doesn't work like that, Jay, I'm afraid. And this is a fundamental problem that we have. In the US, because CEOs are simply remunerated to drive their equity price higher, right? I mean, up until a few months ago, they weren't even remunerated for making a profit. In fact, they were, pilloried for making a profit, right? Because that showed you didn't have enough zeal and you didn't want enough growth, right? So in that environment, what you actually find out is when you look at the correlations between stocks and things like CapEx or capital expenditure and employment, stocks actually lead. So the fundamental problem is to right-size this labor market, we have to get stocks down. Now, to your point, we've just seen initial signs of that, right, in some of these tech layoffs, okay? But they're barely scratching the surface, right? If you look at the other anecdotal evidence, for example, I like to look at the ISM PMI, so the production manager indexes. And I like to listen to what the commentary of the various folks who are involved in that and look at all the responses from the companies that are coming in. And we're definitely seeing a slowdown in the number of people who are hiring, firms hiring on a relative basis to firing. But the relationship is still hiring over firing for that broad economy. So I just don't think we've seen enough. The other example I think you can point to is back in the dot-com bubble, back in 2000, we saw tech stocks obviously get crucified starting in the spring of 2000. And then we started to see layoffs pretty quickly, right? Because they were much smaller companies back then. But the broad US economy didn't go into recession for another 15 months. So the point is this just could be the beginning of what we need to see, Jay. And it's an unpleasant thing to say. We need to see layoffs, right? But we could be still a year away from the actual recession. And the Fed can't let off their guard now because we've just seen what the market wants to do when they do.
Right. Now, and I asked that question because I know a lot of venture capitalists right now are recommending to their companies and their CEOs, you guys need to be holding cash for like 8 to 9 quarters. That's the runway we want you to have right now, which puts you to 2025, which kind of aligns with what you're saying here. Do you think that the tech sector right now is receiving a message from Elon Musk, watching him buy Twitter, take Twitter private, clean this thing up, and show the market, look, you can actually bootstrap a mega tech corporation and get to profitability? I mean, I think that's maybe where that might head. Could that start a trend within major tech publicly listed?
I mean, look, I guess it could, but not many people have got the ability to fund. Well, hopefully they can fund it slightly from a better timing perspective than Elon did, right? Sure. Although I think he was hoisted by his own exuberance on that one, right? He hung himself. If he hadn't been quite so flippant and flash, which he tends to be, he would have been able to wheedle out of that deal and buy it for half the price. Look, I mean, is this going to be a good time for mergers? Some of the smaller companies are clearly going to get bought up by the big boys, but can the big boys go private? I just don't know how you'd fund it in this environment. I really, really don't. I think Elon kind of caught the last of the bank funding. I think bank funding is beginning to tighten. Not enough yet, but it is beginning to tighten. I would question whether you could do that to any of the big boys.
Yeah. Okay. Now, when you look at the FTX blow up that's sort of occurring right now, like, yes, it occurred last week, but it seems like every day the story changes a little bit. Is crypto contagion now at a scale, Julian, that it's no longer limited to crypto? And how much does this affect, broad finance today versus how it might have in 2018?
I think most of the damage has already been done. I mean,
you think so?
In terms of the loss of wealth,
sure.
I think that's already from crypto's already percolated through. In terms of the loss of credibility to the space, I think we're only just beginning to deal with those circumstances. This is not a market. It's very difficult to imagine how this is a market that bounces back very, very quickly. One of the principal issues is going to be how do you get institutional money into this space now? Right, there is no. I mean, I was at a Real Vision conference this last weekend, and I sat next to some crypto guys at lunch, and I legitimately asked them a question. I said, "Look, I was thinking that 12,000 would be a good level to buy Bitcoin. How do I safely buy it? Like, legitimately, how do I safely buy it now?" And they said, well, provided that Coinbase is around when you get to 12,000, you buy it, and then you transfer it straight off the exchange into cold storage. Institutions can't do that.
Right.
So I think this is a market that has to go off into the desert for a long time and do a lot of soul searching, and needs to be heavily regulated. And I know there are, I met a bunch of other people who are at this conference who are trying to institute, truly institutional style crypto warehousing and safety and all, so it'd be like trading a currency or like trading a bond, straight through processing, straight through to custodial. But that stuff isn't available for 6 months, at least.
If you enjoy my content, let's take the next step. I publish a weekly newsletter and it's free every Sunday. The link to subscribe is right beneath this video. I share my key takeaways and action items from conversations just like this and plenty others. So join me and 50,000 other investors for this exclusive content weekly by hitting that link. All right, back to the interview. Now, yeah, some of the major personalities in crypto, people like Kevin O'Leary, for example, he was a supporter of FTX and an investor. And he stated, you know, what he's doing this week is flying to Washington and demanding regulation, like whatever that means, you know, who knows? You know, why do we always have to trend that way and regulate from the top down? Whereas, you know, when it comes to accredited investors, it's quite silly, you know, who is allowed access to what financial products. You know, there's no course to become an accredited investor. Do you ever see something like that materializing, Julian, where instead of just saying, look, we need to regulate top down and you still need to be wealthy to play, how about driving a car is also hazardous to your health if you do it recklessly? So we have a course for this to teach you how to drive it safely. And
you have to wear a safety belt, right? You know,
right. But you own the responsibility after you've gone through the taken the credentials, essentially, right? Like, could you ever imagine a world where accredited investors have to be certified that way instead of based on the numbers in their bank account, which can occur all sorts of haphazard ways? Versus, look, you have to be accredited by taking a course and becoming accredited, do the work, accept the risk, know what's going on, and then step in the pool. Is that a possibility?
It's a nice idea, isn't it, Jay? I mean,
it would be, yeah.
I mean, the problem is it's not really how the system works. I mean, you can sort of see how the system works, right? I mean, and it goes back to, you know, giving power to corporations that's on par with individual voters, right? You know, they're a legal entity. You know, the sheer lobbying power that we have of corporations to design and orientate the system to benefit them. Why would they want that, right? They want to get the most people. They don't want to be restricted. They don't want to be, you know, and it panders to human greed, et cetera, et cetera. So I think, look, in an ideal world, absolutely, this is, you'd have never allowed crypto to get to be this big, right? And arguably, you may not even allow crypto to look anything like this. It looks at the moment, but we didn't, and the greed drove it, and the lobbyists went out and started to talk to DC and were pushing back against the SEC and wanted all this stuff done. And technology moves so very, very quickly that it's very difficult for the regulators to sort of get on top of this and get ahead of this thing. So we ended up where we ended up. It's not the first time. It's not the first time we've had a bubble, right? I mean, bubbles are by nature driven by human greed.
Yeah.
Right?
Which we're not escaping. Any human.
We are not escaping. No, we are definitively not escaping.
Yeah. As long as the system is created by humans, human nature is coming for the ride. Okay, let's get into real time. Where are you allocating capital right now? Where do you feel safe? Where do you feel scared? You know, where are investors vulnerable right now? Talk to me about portfolio allocation. What's catching your attention right now?
So we have started to allocate capital to the longer end of the US bond market, so the 10s and 30s. Started doing that last week. Why? Because we do see the data starting to soften, okay? We do think the data is starting to soften. We do think inflation is peaking. We're skeptical about how far it is going to fall. But nonetheless, it's peaking. We think that growth is slowing. We are seeing some financial tightening going on from the banks, which we think should encourage us perhaps to raise the recessionary threat for next year. We think it's going to be a bit of a struggle. So it's not like we've rushed headlong into this thing and think this thing is going to collapse. You know, yields are going to collapse again. We're going to make a fortune being long the bond market. But to use a professional parlance, it carries nicely, right? So you know, as long as you've got cash, you can earn a decent return. So we like the long end of the bond market. We also feel safe because at least for now, the Fed is being pretty tough. And so that the further that they jack up short-term interest rates, the better we feel about the safety of the value of that long-term bond. On the equity market, we are looking to reshort the market on this rally. Quite exactly how far it goes, you know, could it get up to sort of 41, 50, 60? I guess it's possible. But as I said to you, it is essential for the Fed to get this market down. Okay, they need to drag the market down. And I think investors need to pay much more attention to the quantity of liquidity in the system, which is primarily driven by the balance sheet, as opposed to the price of that liquidity in the system. I've always said for a while, Jay, that the Fed has created a crack addict in the equity market to whom they are now beholden. So when the equity market dropped, and they didn't want the equity market to drop because they were worried about weak growth and low inflation, they always had to come in and reflate the equity market. But the problem with a crack addict is the crack addict doesn't really care about what he pays for the crack, right? If crack prices rise, so in other words, interest rates. So if crack prices rise, he'll just go and steal another car or turn another trick, right? What they really care about is the availability of that crack, right? So if you can't get it, that's when the problems really arise. And when you look at the correlations between the equity price and the availability of liquidity in the system, they're incredibly high, much higher than they are to interest rates. And so I think people do need to remember that the Fed is gradually taking liquidity out of the system. It fluctuates month for month because there are other things that draw on that liquidity. But as long as they keep doing QT, quantitative tightening, and they're taking that balance sheet down, the broad trend of equity should be lower, not higher. You can have these bounces like we had in the summer.
Right.
Okay, and then they fade. So we're looking, and ultimately, if they have to, they've already had, as I said, Chris Waller out there yesterday being very aggressive on the equity market. And if necessary, they'll just tee up Jay Powell again to go out there and kick people in the teeth, okay? Because they've got to get this thing down. So we're looking to sell equities on a rally. That means I'm not touching credit yet. I've still got a lot of cash. I like things like precious metals and resources long term, because I think ultimately we will have to go, we'll create enough pain that at some point the Fed will have to reverse policy, and that should be great for those and should be bad ultimately for the dollar. But right here, right now, they're kind of tough to own on an outright basis, Jay. If I still think that the equity market is going down in broad terms, and my target for the equity market ultimately is 3,000, the S&P. If I still think that is going down, it's very, very hard to own any risk asset outright, right? So even if I think silver looks great, even if I think gold looks great, if the S&P is dropping to 3,000, the odds are that silver's going back to 18 or 17 or something, right? So I can own it on a relative basis. So I can be long silver, short the S&P. I can be long resources like XME against the S&P or the NASDAQ, but I can't be long outright.
When you say long-term, when you say, precious metals, resources, long-term, what's that term? What timeline are you talking about?
I've been looking at this equation, this relationship between XME, so the mining metal resources ETF, and the S&P. And to me, I think over the next decade, this thing is trading, let me pull it up so I can see exactly where it is. This thing on a ratio basis is trading at 0.13. Okay.
Okay.
I think it's probably going to 0.6. Okay. So a 4 to 5 fold increase. And I suspect it's going there over the next 5 to 6 years.
Interesting. That's quite bullish. And so when you play that market, resources specifically, do you just look at indexes like the XME? Do you pick stocks? Do you buy physical? Like, how do you?
I have some physical, which is allocated in the vault and all that sort of rubbish. And then I generally tend to trade ETFs. I've got some buddies who are big mining stock guys and very good. And so occasionally I'll say to them, what do you fancy? And then I put a little bit in these things. But some of these things are so speculative, these mining stocks.
Yeah.
As you well know, they're listed in places like Toronto. They trade in micro size. It's kind of a manipulated market. they all explode and contract instantaneously. You never know if they're actually going to find the damn ore. So I have some of those, Jay, but not with the bulk of the cash. That's like
gambler in you has a bit of cash on the table, but
exactly.
Yeah, well, it's good that you phrase it that way, because fools rush in super quickly when that market takes off, and it does. Like a rising tide lifts all ships. The good, the bad, and the ugly. As a mentor in the space told me a long time ago, he's like, if a company's exploring for gold, therefore it doesn't have any, then whether or not the gold price goes up or down, it shouldn't impact them whatsoever. They don't have the asset that's moving in price, and
or less, right? I mean, if you've got a 50% chance of actually finding the gold and goes up $1, but most of this thing should go up is 50 cents, right?
Yeah, in theory, but they get very speculative.
They do.
And so, I mean, I caution a lot of the viewers of my channel. It's like, if you're going to play in that industry, the resource business, like have your anchor points, the, highly profitable dividend paying producers. And there's lots of great ones to choose from.
Yeah, there's some fantastic companies.
But it's too frequently. I mean, it's exciting. It's like the crypto space. You know what? It is so similar. When I cut my teeth in the gold business, I knew so many gold bugs, silver bugs, all this stuff going back to like 2009, 2010. And at that point, I believed a lot of what I heard because the price kept on going up. So the gurus kept on being right, and you kind of affirm your own conviction. When 2011 hit and that market fell off a cliff, it was like the clothes came off the emperor. And I watched all these individuals just keep hammering gold, silver for 2011, 12, 13, 14. And it's like, oh man, there's nothing here. Like you're a one-trick pony. And so when the crypto market emerged, it was shockingly familiar to me, when it came to the laser eyes and the have fun staying poor. It's the same silliness, right? Anybody who gets dogmatic about an asset class is their own worst enemy.
Yeah, I mean, I've got a few more years on you. I started in bullion in 85.
Okay. Yeah.
So but I've also seen those run-ups where people get very excited. They look at the price action. They frequently but they frequently attach a narrative to the price action, and they overlook the obvious reasons, right? I mean, if you look at a silver chart, I mean, silver is essentially a perfect high beta negative dollar trade. That's what it does, right? So if you look at the price action from 2002 to 2000, as you said, just 11, the dollar high was in February of 2002. Okay, silver at the time was $4.60. The dollar low was literally the dollar high in May of 2011. Sorry, the dollar low was literally silver's high in May of 2011 at $50, right? Yeah. So don't get me wrong, it's a great trade, right? But there's a reason why silver's gone up and the euro's gone up against the dollar this last few days, right? I mean, it's the same bloody trade. But just silver's a great way to play it because it moves way more than most other things, right?
Yeah. You get that leverage. Okay. And I recall actually going to investment conferences and hosting them in October of 2010 and seeing keynote speakers, strut into the speaker hall dressed head to toe in a silver suit, throwing fictitious billion-dollar bills in the air with the stereo system blasting that old metal song, Paper Money Won't Hold, And what always struck me as so humorous is how much hate the silver and the gold bugs get from the Bitcoin evangelists when it's the same song. And I just feel like I've seen this before. Really help me. Euphoria really help me police my emotion, and take a stake in both camps for sure, but with a healthy dose of caution and I hope realism. We'll find out. All right. Look, Julian, it's been awesome having you on the show. I'm glad we could make time. I caught you on Ted Oakley's show. That's and I really enjoyed what you had to say. I've had Ted on the show as well. He's great. But thanks for making the time today. I appreciate it.
Pleasure, Jay. Thank you very much for having me on the show.
last, where can we send people? Obviously, Macro Intelligence Partners right behind you there, but people want to hear more from you.
So yeah, I mean, you can reach out if you're interested in the product. You could reach out to support@mi2partners.com, or if you just want to follow me, the best way, at least for the moment, until Elon really screws it up, is on Twitter, and that it would be Julian @JulianMI2. So @Julian JULIAN @MI2.
All right. Look, I appreciate it, Julian. Thanks again.
Pleasure. Thanks, Jay.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.